Should you embrace the giants? Unpacking the XLK Technology ETF. The technology sector has long been a darling of investors, offering the allure of disruptive innovation and explosive growth. But with so many options available, navigating this dynamic landscape can be daunting. Enter the XLK Technology Select Sector SPDR Fund, XLK, a behemoth ETF that tracks the SP Technology Select Sector Index, a benchmark for the US technology sector. So, the question arises, is XLK the one-stop shop for your tech exposure, or are there better alternatives lurking in the shadows? Let's delve into the world of XLK, dissecting its composition, performance, and potential pitfalls to help you make informed investment decisions. What exactly is XLK, and what does it track? XLK is an exchange-traded fund, ETF, passively managed by State Street Global Advisors, SSGA. It tracks the SP Technology Select Sector Index, which comprises leading companies across various technology subsectors, including 1. Information technology, companies involved in software development, data processing, and IT services. Think Apple, Microsoft, Alphabet, Google, and Amazon. 2. Communication services, companies engaged in telecommunications, media, and streaming services. Think Verizon, AT&T, Netflix, and Meta, Facebook. 3. Consumer discretionary, technology-driven companies in the retail and consumer goods space. Think Tesla, Amazon, and Nike. Is XLK a good investment? It certainly seems like it, with all those tech giants. XLK boasts an impressive track record, delivering strong returns over the long term. Since its inception in 1998, it has generated an annualized return of approximately 12.5%, significantly outpacing the broader market. This performance is largely driven by the growth potential of its underlying holdings, particularly the tech giants that dominate the index. However, past performance is not a guarantee of future results. Several factors need to be considered before diving headfirst into XLK. 1. Concentration. XLK is heavily concentrated in a handful of large-cap tech companies. As of today, the top 10 holdings account for over 50% of the fund's total assets. This concentration amplifies the impact of individual stock performance on the overall fund, making it susceptible to fluctuations in the fortunes of these top players. 2. Sector bias. By focusing solely on technology, XLK lacks diversification across other sectors. This can expose your portfolio to heightened risk if the tech sector experiences a downturn. Consider whether XLK aligns with your overall asset allocation strategy and risk tolerance. 3. Fees. While XLK boasts a relatively low expense ratio of 0.1%, compared to actively managed funds, it's still a cost to consider. Over time, these fees can eat into your returns, especially if the market experiences prolonged periods of low volatility. Are there any alternatives to XLK? The ETF landscape offers a diverse array of options for tech exposure, catering to different preferences and risk profiles. Here are some alternatives to consider. 1. Sector-specific ETFs. Explore ETFs focused on specific technology subsectors like cybersecurity, cloud computing, or semiconductors. This allows you to target specific areas of growth within the broader tech space and potentially mitigate concentration risk. 2. Broader market ETFs. Consider ETFs that offer exposure to a wider range of sectors beyond technology, like the SP 500 or the Vanguard Total Stock Market ETF, VTI. This diversification can provide a more balanced portfolio and potentially cushion against downturns in the tech sector. 3. Actively managed funds. If you're comfortable with higher fees and the potential for outperformance, actively managed tech funds offer an alternative. These funds employ professional managers who actively select stocks based on their research and analysis. So, should I invest in XLK? The decision ultimately depends on your individual investment goals, risk tolerance, and overall portfolio strategy. XLK offers a convenient and cost-effective way to gain exposure to the leading names in the technology sector. However, its concentration risk and lack of diversification necessitate careful consideration. Here are some key takeaways. 1. XLK is a well-established ETF with a strong track record. 2. It offers concentrated exposure to the top players in the US technology sector. 3. Consider its concentration risk and lack of diversification before investing. 4. Explore alternative ETFs and actively managed funds for a more tailored approach. Ultimately, the best approach is to conduct thorough research, understand your risk appetite, and seek professional financial advice if needed. Remember, there's no one-size-fits-all solution, and the answer to whether XLK is right for you lies in your unique investment journey.